Dow 30,000 doesn't seem that far away. US stocks continue to be on a tear. Do we get outperformance from the US this year, or do we get it elsewhere?
I like the old stock market sayings, and one of the oldest ones is that bull markets narrow. This bull market started 11 years ago, and it's narrowing into the S&P. Your point you were saying earlier that it's fairly typical for the S&P to forge ahead, European markets to lag. They're not doing badly, but the S&P is doing better. So we're expecting the US to continue to lead the way this year.
But Europe looks cheap. Like the relative valuation story looks cheap, and if Europe has any chance, it's got to be now with the kind of valuations that we're seeing in the States.
Yeah, I mean, that's one of the great conundrums of this cycle. Buying cheap stocks has not worked. Buying cheap markets has not worked.
Value started to work a little bit more.
Yeah, there was a bit of rotation in September, October of last year, but I'm afraid growth against value is now making new highs. And at a global stock market level, the S&P is the growth trade. Europe's the value trade.
In terms of what has ultimately driven us over the last 12 months, it's been multiple expansion.
Yeah.
Do we get central banks helping out with that this year? Is the lower rate story going to come back and help us at any point in the next 12 months?
Yeah, I mean, think about it. This time a year ago, we were expecting 2 rate hikes from the Fed. We got 3 cuts, so we were 5 parameters out on that one. We're not expecting that kind of help this year, but the taps are still on. I just don't think they're going to be opened even more.
What happens when they get turned off?
Yeah, well, we saw a little bit of that in 2018, right? The markets have got addicted to cheap money, and one of the problems with that is that if you take that cheap money away, they can have tantrums.
Talking of tantrums, people are back shorting volatility at the moment.
Yeah.
It's pretty depressed, and yet people see it going even lower. What does that tell you about the markets, about sentiment right now?
Well, we think that that's one of the things that has really been manipulated, is that the right word, or affected heavily by central bank policy, which is volatility. They are effectively taking volatility out of the market that if we were pricing things would definitely be there. So while the central banks remain in place, I think volatility is going to stay fairly low.
Just forever?
Not forever. You know, they're not going to stay with the taps as wide open as they are right now forever, but I think that's one of the things they're doing. They're suppressing volatility. We will see blips and corrections and so on in the market, but central banks are buyers of vol. That's one of the reasons why volatility is so low.
But dispersion's going to stay very low this year by the sounds of things, judging by that vol story. It doesn't sound, again, like a year for active managers. It's
going to be difficult. Most people are just buying an S&P tracker and doing very nicely out of that, thank you very much. I think that will probably likely continue this year.
Just in terms of, you talked about kind of mid-single-digit returns this year.
Yeah.
What do the tails look like in that forecast?
Yeah, I think if you were going to say, give me 10% swing, tail either side, I'd be on the upside, not the downside.
OK. What would get us to the upside then?
People start buying this market. One of the really extraordinary things about last year is we made 24, 25% on global equities without much flows into equity as an asset class. We did it despite fund flows. Normally we do it because of fund flows. I think we could get that extra spurt to the market if people start really buying this
fear of missing out.
Absolutely.
Is that retail investors or is that institutional investors? But institutional investors feel more invested than retail does.
Yeah, but kind of everyone. I mean, institutional investors are often just agents for the decisions of retail investors, right?
Sure, to a point.
Yeah, so we've just not seen participation in this bull market. I think that's one of the reasons why it feels like one of the grumpiest, most gloomy, most miserable bull markets I've ever seen in my life.
Earnings?
Earnings, we're expecting 4 or 5% global this year. What worries me a little bit, if you want a bit of a bearish story, analysts are on 10%. So that number needs to come down. But as we saw last year, the number came down 7, 8%. Still, the market went up 25%.
Where does the risk lie in the earnings story? Is it the top line, is it the bottom line, or is it the middle of the P&L? Because input costs, to a certain extent, wages could be one of those, have the potential to rise. Yeah,
we're seeing late cycle increases in wage inflation. I think that the risk to that forecast is generally in cyclical stocks where analysts are forecasting a bit of a rebound this year. So a lot of that 10% comes off us expecting, analysts expecting earnings numbers in cyclicals to be up 15, 20. I think that's where the risk is.